Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
It's your boy Andy, and welcome back to the DeFi Slate YouTube channel. Smash the like button on this video, that really helps us out, and sit back and enjoy the content. Thank you very much. What's going on, y'all? Welcome back to episode 59 of the DeFi by Design podcast. Here today to talk about some of the updates of DeFi that we've seen just in the sector as a whole. We're really seeing a lot of evolving features and factors happening. A lot of different chains now layered to different types of protocols and liquidity and all sorts of stuff. And lucky for us, we're sitting down with the lads from the Bancor team. Haven't spoken to these lads since September of 2020, where Nate and I did a video about Bancor V2. We actually talked about some of the Sushi Swap OG farming pools, man. We came a long way since then. The markets are all over the place right now, but what's important is we're seeing continuous capital and social capital growth into the ecosystem. So I'm excited to talk more about DEXs and AMMs and kind of the evolvement of liquidity mining, yield farming, and this kind of DeFi 2.0, 3.0, and what's coming. So excited to talk to Mark and Nate from Bancor and pass it over to my boy Rob. How you doing, Rob?
Yeah, good morning, everyone. Thanks for listening. It's January 6th, and markets are a little all over the place, but I think everyone is still very excited about the future of DeFi as a whole. Today we're going to talk about the evolution of AMMs and DEXs, kind of how liquidity has gone from like this renting model into more of a protocol-owned liquidity model. These are like the OG AMM guys to be talking to, Mark and Nate. Bancor was one of the first AMMs launched, and they've came a long way. V3 is now coming out, and it's right around the corner, so we're going to dig into that, as well as all the evolution around AMMs and DeFi. So I will pass it over to Mark and let him introduce himself. What's going on, Mark?
Thank you, Rob. So my name is Mark Richardson. I'm the head of Bancor's research right now. Before I was in DeFi, before I was working for Bancor, I was actually just one of their community members. I was there when the DAO first got established in October of 2020. I helped put together some of the first proposals that organize how our DAO operates, and I also put together part of our deflationary mechanism that's called the Vortex. And so I, as a community member, I was kind of contributing to the contract sort of in my free time, but then I accepted a invitation to work for Bancor full time from the Bancor Foundation in January of 2020, and so I've shifted from my career in the physical and life sciences to working in DeFi full time at that time. But before then, I had a postdoctoral fellowship with the Australian government, working for an organization called the CSIRO. This is the company that invented Wi-Fi. They invented stay-in contact lenses. They invented insect repellent. It's a pretty big organization. And there I was working on sort of, fast test strips for COVID diagnoses. I was working on, other types of diagnostic devices for things like drug-resistant infections and other things like that. Before that, I was a lecturer for the chemistry department at UCI. And before that, I was a PhD student at Melbourne. So it's been a weird transition, I would say, but not one that is too out of character for the scene. It seems that the more and more I talk to other people in positions similar to mine, they seem to actually come from non-financial, non-economic backgrounds, and they actually have a lot more in common with the physical and life sciences anyway. So I don't feel as out of place as you might expect.
Ozzy, mate. Yes, sir. Well, welcome on, and I'm excited to hear more about your experiences so far. And Nate, let's kick it off. How you doing? A brief intro and maybe a quick update as to kind of what you've been working on the last year and a half or so since we've chatted, and we'll take it from there.
Yeah, great to be back on again. Nice to talk to you guys. My background is I've been with Bancor since late 2017, early 2018, always working on growth. As you mentioned, Bancor invented the first AMM on the blockchain. So really focused over the past 4 years, it kind of educating on what decentralized liquidity means, how it can grow, the risks, the rewards, and then just in the past 2 years or year and a half, I think we've really seen an explosion in the usage of AMMs and in liquidity pools, and finally people really starting to get these concepts well and have them really play a fundamental role in the growth of ecosystems across different blockchains. Before that, was involved in some mobile startups, had some exits, and before that was a financial journalist working on covering the stock market and new financial technologies. So that's a quick bit on my background. Now, to answer your question, in the past, let's say if we spoke in mid-2020, we were gearing up to launch V2.0, which was a very interesting time for us. We discovered some very fascinating things about the way impermanent loss works and what it really is, and have really evolved Bancor into a protocol that, or as a team, we've evolved as really sort of the scientists on impermanent loss and how to maximize yield on AMM liquidity pools, and why impermanent loss is such an important part of that story. And so Bancor quickly pivoted into V2.1. We found a very unique way of using protocol-owned liquidity to co-invest with liquidity providers and figure out how to cover them from impermanent loss, to create this really simple and safe way to provide liquidity in a single asset, not in two, like in most AMM pools like Uniswap or Sushi, and also be fully protected from impermanent loss, so that if your token goes up and if there's volatility in most pools, you can pull out less than if you just held the asset on its own. In Bancor, that's never the case. We're always tracking the HODL value if you just held the asset in your wallet, and ensuring that you get back at least that plus trading fees and mining rewards. And so in the past year and a half, we really iterated and optimized on this sort of simple, we call it safe staking model. We saw liquidity reach upwards of 2 billion from, I think when we probably spoke, it was around like 15 million. Users has gone up quite a bit with that volume. The DEX landscape has evolved quite a bit, and DeFi, became a thing. And we're now on the precipice of launching our next version, Bancor V3. We've just, in the past month or so, announced what the features of the first phase of V3 will be. We haven't even announced what the second phase will entail, but there's already a lot of meat to chew on in that first phase. And we're really doubling down on this sort of simple, safe mechanism of getting yield on the assets that you love. And we're, really focused on allowing you to earn more on your tokens while doing even less and have it costing even less. So yeah, that's a high level of kind of where we're at today, and look forward to sort of digging in wherever you guys want to go.
Yeah, dude.
Yeah.
Shout out to your OG article back in the day on impermanent loss. That thing probably saved me from like getting wrecked in so many pool twos. You don't even understand. I was so close to going into so many pool twos.
I'm glad. Well, now we actually have a tool that if you have been wrecked on those pool twos or on any pools, you can go to something called il.wtf. You guys might know fees.wtf, where you can see your gas, the gas you spent over time. Well, we have il.wtf now, and you can just plug in your wallet address, and see how much impermanent loss you've suffered over time. If you share it, we're awarding a certain number of LPs who share their IL. In a given month, you'll get a Bancor bailout. So we'll send you $1,000 in BNT. But this is another mechanism to really get the word out that there's $30 billion roughly staked in AMM pools, and a lot of that liquidity is actually losing money versus just simply holding the tokens outside of the pools. So we're really focused on getting the word out and that, and really helping people understand why we think IL risk should not be in the hands of everyday users and liquidity providers and should be managed by a protocol.
To any listeners that are thinking about using this website, just make sure that you're sitting down before putting your wallet address into there. There are some of the losses on there have been cataclysmic, and it's you might be surprised to see just how much better off you would have been by not being involved with some of these DeFi protocols.
Yeah, I just took a look at one of the addresses, and I'm glad I was sitting down. Yeah. Thankfully, I'm not wearing socks, or else they would have flown off. Yeah, so that's super like important, right? For DeFi to get a handle on the amount of impermanent loss that we're seeing, and kind of educate not only users but also builders and founders of decentralized exchanges as far as the types of protections that they can put in place. Now, like my understanding, and this might be consistent with our listeners' understanding, is the traditional AMM model is X times Y equals K. And without even getting too technical or in too much math there, it's kind of like that seesaw model where if one side of the pool increases, it starts to sell that side of the pair and buy the other side. And that way X and Y kind of balance out so that K is always maintained. Is that kind of where Bancor started? Maybe you could give us like a brief history lesson as far as how Bancor originated in that model, and then the evolution that y'all have taken up until now to really fix some of those impermanent loss issues.
Yeah, certainly. Nate, do you want to take the first part?
Yeah, so just on the first part, and then I'll let Mark sort of take the closer to today. The issue with IL is that the LPs have different interests than token holders. And this kind of creates an issue, right? You want the people who are holding your asset to make it more liquid and also earn money from doing that. And when you have the liquidity that's sort of spread across, thousands or millions of token holders, that liquidity becomes more robust. You don't have a big whale that can just withdraw it at any second. And so you, from our perspective, want the interests of your token holders and your LPs to be aligned. You also, if you ever want to drop rewards on your pool, or even as a project, if you want to provide liquidity to your own token, you want to, if the token goes up, to ensure that you're making more money. Now, the issue with impermanent loss and the sort of seesaw model that we saw pretty early on I'd say even in 2017, we were doing protocol on liquidity because we were working with projects that said, yeah, I want to open up a pool and I want to provide all this money that we just raised through our token sale to the pool and get this sort of passive earnings. But what we would see happen is when the token went up a lot, the pool, like you said, sells it off at a discount to arbitrageurs who end up, such that the pool will lose more value than it earns from the trading fees. And so we saw this kind of misaligned interests and really felt that it had to be fixed, that people who are long on an asset should be able to provide liquidity and get passive earnings on it, and should not be punished if it goes up a lot and they could have said, oh shoot, I should have just been holding it in my wallet. And so that's how we sort of approach the problem is, how do we set up a model where the risk is transferred off of the liquidity provider and sort of diversified across a wide number of tokens and sort of managed by a protocol, in this case Bancor, such that you're really only providing liquidity or protecting against liquidity where it's sort of profitable for the Bancor protocol. So now, I'm getting a little deep in the tokenomics and all that, but I guess what's just important for you to take away from this is that we saw misaligned interests between holders and LPs, and we saw the importance of decentralized liquidity to early stage projects. And so we're focused on designing something that align the interest of token holders and liquidity providers. And so I'll let Mark kind of clean up and take us to sort of, today.
Yeah. So I think one of the ways that I've been discussing, AMMs with people that aren't like super familiar with DeFi, or might not have a strong mathematics background or something like that, but are still buying and trading cryptocurrencies, is like Andy, what's your favorite cryptocurrency right now, other than BNT, of course?
Shiba.
Shiba, right. And so, do you use a centralized exchange for that? Like maybe, I don't know, Binance or Kraken or something?
Yeah, exactly.
Yeah, so have you ever wondered, like, okay, so let's say, I don't know what the trading, what Shiba is trading at right now, but let's just pretend it's $1, just so that we've got some easy numbers to deal with. And
I'm a billionaire.
Exactly. One day, Andy, one day. But let's just say, like, let's say, you're convinced that Shiba is going to go to $2, right? It's the reason you're buying it at $1. But then I come to you and say, hey, Andy, like, I want some of this Shiba token. Sell it to me for $1, right? Are you going to do that? Are you ever going to sell me the Shiba that you have at the price that you're currently buying it for on whatever centralized exchange you're using?
No.
Right?
Why would I do that?
Exactly. Why would you do that? What markup would you offer? Right? How much extra do you want me to pay for your Shiba?
Right here, right now, I'll give you 3.5% extra.
Right. But what's interesting about this is that people often forget that when you're buying these things, it's not someone from faceless entity. There is someone who is selling you their own Shiba tokens, right? And they are agreeing to sell it to you at whatever the current market rate is. And the way that they determine what a Shiba token should be worth is because they're using something called an order book. And this is a way of balancing sort of the buying pressure and the selling pressure across an exchange. And when one starts to dominate the other, that's when the price moves in one direction. So, why then would someone be willing to buy and sell Shiba according to whatever the exchange tells them to, right? Whatever the order book tells them to. And it's because that they're running a very sophisticated financial strategy that you can't use, right? They're not just buying and selling Shiba, they're buying and selling hundreds of different cryptocurrencies simultaneously. And they're using, these guys have, backgrounds in quantitative financial analysis. They're worth, more than $500,000 a year just in salary in order to balance the risk metrics that allow them to execute these things. And the point is that these guys, this small handful of very gifted individuals, control the whole world economy. Have you ever moved through an airport, like maybe you visited Australia, right, from the United States, and have had to convert your US dollars to Australian dollars, or something like that? Like maybe you visited Europe or had to buy euros. Have you ever wondered, why is it that the American dollar is worth what it is and the euro is worth what it is, right? Who determines that? What equation or something is being applied in the background that says, no, the US dollar is worth this amount and the euro is worth this amount? And why does it change? It's a really abstract concept that normal people have never really had to think about. But the reason is, there is that same market maker, that same person that is selling you Shiba is also selling Europeans American dollars and Americans euros, right? It's a very, very tight-knit, small, centralized community, and they determine what everything is worth. And in a way, that's an extremely corruptible process, but it's also a huge responsibility, right? No one really actively seeks out this thing, right? It could be that, during huge market turndowns, for example in Shiba, that they're pulling their hair out over just how dramatic, the price is dropping and that they can't get it off their books very quickly. And so moving to a decentralized liquidity solution where these market makers aren't so concentrated, where they aren't, controlling the whole world economy, seems like it could be a very convincing use case for cryptocurrency. And it's why we invented the automatic market maker, because it allows regular people who don't know about quantitative financial analysis, who aren't worth, $500,000 a year to a hedge fund, to participate in these markets and support exchange. And that's valuable because it means that the system can start to take on its own characteristics, and we don't need to entrust someone that we've never met with correctly valuing, for example, the US dollar. The problem is that because you don't have that strong financial background, you're not using the same sophisticated hedging strategies that they are, and so you might actually be, as a novice, right, as an amateur, exposed to these huge downside risks. And that means that we cannot rely on this system alone to incentivize regular people to become liquidity providers. There needs to be something there, right? There needs to be another layer of automation on top of it that is implementing those sophisticated market making strategies on your behalf so that you aren't exposed to those catastrophic drawdowns. And that's what Bancor is doing right now. It's saying if you provide liquidity, that's the only action you have to take, and all of that high level, risk-adjusted hedging and everything like that, that's going to be conducted on your behalf so that your value is always protected. That's what Bancor is about. It's about helping regular people to be, to implement the same strategies that these, $500,000 a year quants are implementing on Binance, on Coinbase, and that are selling SHIB to you right now at whatever you're buying it for.
Facts. Yeah, that's a really good explanation for why we need these sort of strategies implemented. Ultimately, the understanding impermanent loss and liquidity provision already puts you at a level of, I would say, intermediate currently in DeFi, but that skill and knowledge still doesn't protect you from your own downfalls in terms of greed, in terms of wrong conviction, etc. So let's kind of dive deeper into that and see how are the current structures of let's go into the protocol owned liquidity kind of segment as part of this. So how do you see the protocol owned liquidity that development? How does that coincide with this kind of strategy of protection of better LP positions, of stronger liquidity? What are your general thoughts, and perhaps just a brief explanation of what POL means before you kind of get into your opinion?
Yeah, sure. So I don't think protocol and liquidity it doesn't have one consistent definition yet. But in general, I think we can all agree on what the high level concept is, and that's the idea that the protocol itself offers liquidity against the token that it's responsible for across a wide range of pairs, and that there's no one that can withdraw that liquidity, right? And that last part about no one being able to withdraw the liquidity is the part that I don't necessarily agree with. So let's have a look at what protocol and liquidity on Bancor looks like. Bancor is a unique AMM because you don't need to hold more than one token. If you want to provide liquidity just with Shiba, right? If we had Shiba whitelisted, you could just do that. You don't need to have ETH or something. You don't need to supply the other side of the pool. You just supply the one token that you want to be a liquidity provider for, and that's it. Whereas if you're on something like SushiSwap, the general user experience is that you need to provide sort of equal value of Shiba and ETH and supply both sides of the pool simultaneously. Now, the reason why Sushi does that is because it doesn't have a universal numeraire, right? It doesn't own ETH, even though ETH is in all the pools. ETH is not its token, it's someone else's project's token, right? It's the token of the blockchain. It's Vitalik's token. It's the Ethereum Foundation's token. It has nothing to do with SushiSwap. They've just decided to onboard it as the main token that powers the whole ecosystem, which if you think about it, as being like, using, I don't want to say a competitor's token, but the token of a project that you have nothing to do with, it's weird, right? Like, imagine Bancor deciding to use SHIB as the main token of our ecosystem. It would just be, maybe we could do that. But it's kind of strange because there's now this huge component of your own product that you don't have control over, right? That is now at the whim of some other DAO or some other community or some other collection of developers. And they now have this huge influence over the health of your ecosystem. So Bancor, instead of using ETH as the main token, it uses its own token, BNT, which is something that we do have control over. And that gives us access to much more sophisticated monetization policies for the protocol, including things like impermanent loss insurance and single-sided staking. So on the protocol-owned liquidity side, it's the BNT that we're talking about, not the rest of the tokens. So if you approach the Bancor AMM and say, hey, I want to provide, $10,000 in SHIB liquidity, the protocol will say, fine, I will combine that with $10,000 of my own BNT tokens, and we become business partners. And that is the strategy of the Bancor protocol and the Bancor DAO with regards to protocol-owned liquidity. So you who own the SHIB tokens, you will always own the same value of SHIB tokens plus whatever trading fees that you've earned on that side of the pool, and the protocol will always own the opposite side. And so when you withdraw, the Bancor protocol also withdraws, and it burns its BNT tokens. So in that sense, the Bancor protocol, I think, currently owns something like 85% of the total BNT in existence, and it's mostly used to provide liquidity against liquidity providers such as yourself, if you wanted to provide liquidity. And so the important distinction here that I make between Bancor's approach to protocol and liquidity and something like Olympus DAO is that if you want to withdraw, let's say that you're done, you're like, oh, that was fun, I've made some money, SHIB's gone up in value or something, I want to withdraw my liquidity now, Bancor will let you, right? So we don't own your SHIB. Whereas with Olympus DAO, you can never withdraw. After you've provided your SHIB to the protocol, you'll never get it back. And so in a sense, things like Olympus DAO are really just something like a yield aggregator like YFI, except you never get your money back. I think things like Olympus DAO are, they have some really interesting sort of aspects to how they handle their own token. So for example, the OHM token, or whatever the fork is on Avalanche in Wonderland or whatever it is. They provide these like huge inflationary rewards on that token, knowing full well, and even with the bonding mechanism that they offer, you can buy that token at a discount if you wait 5 days or something. But all that does is create an arbitrage opportunity, right? And so even though they have these protocol-owned liquidity systems where it seems like users are never going to be able to withdraw their tokens back, by debasing the currency, what it allows users to do is effectively buy it back over time. And so what ends up occurring is you end up converting something like an 8,000% APY, which is, I think, what Olympus DAO is currently running at. Because the protocol itself isn't actually generating 8,000%, all it's doing is forcing the token price down by that same rate. And so the protocol ends up owning a lot of OHM because people are trading it back for the token that's on the other side of the pool. And that's kind of where the protocol ends up just owning everything. Whereas on Bancor, we don't need to debase the currency because if you really wanted your tokens back, you can just withdraw and the protocol will buy it. So, whereas things like OHM don't deflate until they reach $1, right? OHM is still sort of a quasi-algorithmic stablecoin, like it's supposed to be pegged to a DAI. It's just going to take a little while to get there. For Bancor, it's not targeting any price, and it will deflate every time you withdraw. So the BNT is only present for as long as it needs to be there, and when you withdraw, everyone shakes hands and walks away with their profits, and the protocol burns all of the BNT that it has left, plus all of the BNT that it garnered from the secondary markets as a result. So it's different approaches. It's still both protocol and liquidity, but at Bancor we want to make sure that the users still own their liquidity, right? Whereas projects like Olympus DAO want to make sure that the protocol owns all of it. And I think one of these is sustainable and the other one isn't. And I'll let you determine which one, which side of the aisle I'm on for things like that.
I think Nate wants to hop in here, and before he does, just a real quick yeah, go ahead, Nate.
Oh, sorry if there's a lag.
Nate?
Yeah, can you hear me?
Yeah.
Can you hear me now? Sorry about that. You guys good? Can you hear me?
Yeah, we can.
Okay.
Oh,
yeah, sorry.
I'll text him on Telegram.
Can't hear me? No?
Nathaniel? Okay, he's dropped out.
He's gone.
Yeah, Mark, I had a quick question, kind of before Nate shares. Is you spoke a lot about the deflationary mechanism of BNT and how as the liquidity is pulled, and how it essentially how a user, when they pull their liquidity, the other side of that pair is burned in BNT, and of course that leads to a deflationary supply of BNT. Is there an inflationary counterpart? To
so
that?
at the time
if you could explain.
Yeah, of course. Yeah. So BNT is not. I wouldn't call it a deflationary currency. It's. I would say when it's running well, the protocol is attempting to hold a stable supply. So we're not trying to burn BNT indefinitely. We're not trying to mint BNT indefinitely, but we do need to make sure that the protocol scales pretty well. And the fact that so if what I'll do is I'll talk about how most of the inflation happens, and then we can talk about why that's price neutral. So for example, the Bancor DAO will decide on what we call a funding limit, and this is basically the size of the pool that we're willing to support. And there are a couple of parameters that we have to consider. One of which is, what is the likely insurance risk associated with that token? Because if you're providing SHIB and SHIB goes 1000x, right, as I'm sure that everyone hope it does, on Bancor, unlike any other DEX, we say, fine, if it goes 1000x, we're going to give you all of that value, right? If you withdraw, we're going to make sure that you have all 1000x of that valuation appreciation at the time you withdraw. The problem is that as the SHIB token goes parabolic like that, the secondary markets are actually going to be buying those SHIB tokens off of the pool, and they'll be buying it with BNT, or that's the best way that you can think about it. And so this means that if you do want to withdraw, then there's going to be slightly less SHIB there, or maybe a lot less SHIB there than what you actually originally provided. And that's when the insurance contracts kick in and reimburse you the remaining difference in the token that the protocol has, which is BNT. So you'll still always have, whatever value that you thought you should. It's just that the denomination might be changed a little bit. And so that's one of the sources of inflation, or these insurance payouts. But that is partially offset since July has been entirely offset by what we call the Bangkok Vortex. And so how this works is that there's a complex component that's going to be a long conversation. Maybe we'll leave that for a dedicated podcast. I'll just do the short version here today. And that's that all liquidity providers on Bancor forfeit 15% of their fee revenue. So we don't touch your principal, right? If you provide $100, $100 is always there. But if you then earn $100 in fees, the Bancor protocol currently takes $15 of that. So for every $100 that are actually earned on your tokens, you get 85, and the protocol takes 15. And that 15 is used to buy and burn BNT. So as long as the protocol is performing well, the idea is to basically balance that token buyback and burn with the rate of insurance payouts. And so as long as those two numbers are almost equal over long periods of time, then the cost of providing insurance for these kinds of impermanent loss events is neutral compared to what the protocol is actually doing. So the idea is that insurance payout and the protocol earned fees cancel each other out, and so the inflation matches the deflation. The other ways that the protocol inflates and deflates is during liquidity provision and withdrawal. So when you provide liquidity to a pool that has available funding, so for example, adding $1,000 of SHIB, the protocol has to mint $1,000 of BNT in order to support that deposit and complete the complete the liquidity pair. And then when you withdraw, whatever is you get whatever you're supposed to get, and the protocol will burn the BNT on the other side. So these are basically the four components of inflation and deflation that the Bancor protocol is constantly balancing, and what the Bancor DAO is responsible for the management of. And so that's making sure that roughly the amount of BNT minted during deposits is roughly the same as the amount of BNT destroyed during withdrawals, and that the amount of BNT destroyed as a result of the insurance premium is about the same as the amount of BNT paid out in insurance payouts. So those are the sort of the inflationary and deflationary forces. And in general, over the course of version 2.1, it has been basically break even. We've been doing pretty well about that. So there are weeks or months, where it might becomes a little bit inflationary or a little bit deflationary, but it's basically, a wiggly line around the break even component. So far so good.
Can you guys hear me? Awesome. Okay.
Yeah, we've always been able to hear you, Nate.
Oh, sorry about that. I just want to simplify this a little bit, and protocol liquidity, you can think of it first as like, how does Bancor work, or how does Olympus work? So like, how do our individual protocol owned liquidity mechanisms working? But then you can also think about it, and there's a way to hold in on it, where for your sort of token communities and projects, what does protocol owned liquidity look like for them? And I think there's like a fairly easy way to define protocol owned liquidity, which is just when a protocol acquires or owns its LP tokens. So when it either, in the case of like Olympus Pro, can sell its tokens at a discount for its own LP tokens, or in the case of Bancor, if a protocol can deposit its treasury into Bancor pools, which then acquires its LP tokens, and then it owns its LP tokens. And I think as a sort of, let's say, liquidity as a service solution, there's a very key distinction between, let's say, an Olympus Pro bonding model and a treasury acquiring its pool tokens by depositing in Bancor pools. And that's where, within the Olympus model, you acquire your Uniswap liquidity pool tokens, or your Sushi liquidity pool LP tokens, or another AMM. And well, what do we know about most AMMs is that they're subject to impermanent loss. So as the value of your token goes up, your LP tokens, the value of those goes down, and you're suffering impermanent loss on those LP tokens that you own. Now let's think about it when you acquire your own liquidity, or own your own liquidity through Bancor. That is, and we've seen now 6, 7, I think we're over 10 and close to a dozen projects that have started to do this. They've said, hey, wow, Bancor offers a pretty crazy service, single-sided exposure with IL protection. So I can take my own treasury that I have, provide liquidity to a Bancor pool, own my LP tokens, and not only I'm holding single-sided LP tokens, so I'm only having to provide my token, but those LP tokens that I have, that are technically a part of my treasury now, are not subject to IL. So even if my token moons, they're not losing value. They're maintaining value, and I'm earning yield on top of that. And so I think that that's a pretty interesting way to look at, I actually did a quick thread on this last weekend, but I've started to call it like PPOL, Protected Protocol Owned Liquidity, or like people. I I think that is a much stronger, or, I guess both kind of have some benefits. I think there's sort of clear benefits to that, which is as a treasury, you can provide your treasury to Bancor and have these protected LP tokens. And also you don't have to provide, half the pool in ETH or another asset. So that's another interesting way to look at protocol and liquidity, not just how Bancor is designed with its own protocol and liquidity or Olympus, but what's the service for other, other protocols.
Yeah, and the value add, that's important as far as the offer from Olympus, from Bancor, from other protocols, and I'd like to kind of switch us up here to the tokenomics of these DeFi 1.0 protocols, including Bancor, including any protocol that kind of institutes its own liquidity mining via a DEX. The ones that we've spoken about today are Sushi, and of course there's Uniswap and others. Now the question here is regarding the voting lock model of Curve. And not to be a tokenomics hater, but my interpretation of buyback and burn is that it's kind of a waste of energy of tokens. Yes, it accomplishes the deflationary model, but in the same time, it could be used for something like a VE model for Sushi or for Bancor in this case. So sticking to Bancor, what are your thoughts on implementing a VE BNT model where you can effectively have votes to offer liquidity mining on different pairs via VE BNT, thus creating this kind of desire to own as much VE BNT as possible, thus a desire to own BNT. And I think we're kind of in the mid stage of this game, if you will. Curve really got it off early. Now we're seeing kind of like the wars for Tokamak and a few others. And just real quick, if you could give an explanation to our audience as to why the voting mechanism is important and why the Curve wars even exist. And then I'd love to hear your thoughts on implementing a similar one for the pools on Bancor and for the Bancor token.
Mark, you're
so
on.
I think, I got it. Okay. So it is certainly an interesting model, but again, a lot of this, a lot of this desire, I still feel like is an illusion, because how it's generated is entirely through inflation, right? So you're not actually generating value. You're just cutting it up into smaller and smaller pieces. So my view of these types of models and liquidity mining in general, by the way, is that, it's like you've got one piece of pizza or something, or you've got like one pizza that's come out of the oven, and then you tell people that they're going to get twice as much pizza. And so what you do is you cut the pizza in half, and it's like, now we've got two pizzas, right? And so you've just made 100% yield. And someone's like, yeah, but I want 400% yield. And it's like, fine, so I'll cut those into half again, and now we've got quarters of a pizza, right? This is all it does. It's just a stock split model. And so what's interesting is that I think that the market partially isn't smart enough to know that that's how these things work. I think that, and I don't mean that necessarily as meaning that people aren't educated enough or something like that, but just humans, when they're in a, this euphoric phase of how, seeing number go up in DeFi, generally have difficulty seeing the forest from the trees. And it affects even some very smart people. So when I say that, it's the market isn't smart enough to figure this out, I don't want you to think that I'm, thinking that regular DeFi users aren't intelligent people. They clearly are. It's just that sometimes the illusion can be so convincing that it can be difficult to see anything else, or people are subscribing to that greater fool theory, and they wonder how much longer it can continue. So let me just...
And Mark, real quick, is part of your thesis, and we'll take it to the Curve model, is that surely you can lock up Curve, but at the end of the day, all Curve is doing is inflating their token through all their pools of liquidity mining. So it's like you're locking something that's also being inflated to get more of what's being inflated as well.
Yeah.
Right,
Yeah,
right.
And
so at a certain time.
Yeah, so what you've actually done, it's not really an incentives model, but a disincentives model. Because if you don't participate, you're going to get diluted, right? And that's really the why I think it's so effective. So it kind of forces you to participate for risk of losing, losing interest in the token that you already own. And I don't think that that's necessarily a good model to do it. And by the way, Bancor is also partly guilty of this, but just in much less dramatic fashion. Because we've also had a liquidity mining program that's been immensely successful, and it still does have this property of diluting people that aren't staked in the protocol. And so I don't mean to put us on a pedestal and say, hey, we're not playing these games, because we have played them. I just think that we really need to start growing up and thinking about where does value actually come from. And eventually, the only sustainable business model has to be one that's contingent on fee-paying customers, right? People that actually bring in value that wasn't already there. The other problem that I have with these kinds of governance models is that at some point, the reason we like DAOs is because the token holders themselves are invested in the health of the protocol that they are subscribing to. But with things like what Curve is doing, and why I think these inflationary rewards and the types of bribe system that they've introduced is not good, is that it's demonstrable now that a lot of Curve voters don't care about the Curve protocol, right? They will vote for whatever is required to get them the reward from whoever is offering it. So things like
Convex or Urine or whatever it is.
Exactly,
yeah,
right.
Makes sense.
They will still vote it in, even if they know it's a bad idea. This has resulted in some very near misses for Curve, right? Things like the Moshi token, which was one of the Azim's scams after Armify and things like that. Going into it, right? If you have a look at the governance chats within Curve itself, there are community members that are deeply committed to Curve's continuity, and they should be, right? Curve is a phenomenal project. It has got, it's got some of my favorite ideas, like some of the actual good innovations in the DEX space, and there aren't many, have come directly from Curve, right? I'm a big fan of, their stable swap invariant for stablecoins was nothing short of brilliant. Their implementation of concentrated liquidity, I would say, is actually better than Uniswap v3s. It's not making a huge amount of money right now, but that's okay. Everyone is still sort of sorting everything out. The point that I'm making is that Curve is a terrific project, and it's a shame that the DAO seems more concerned with what tokens they're getting than what is good for the protocol, and that's an issue.
Yeah, so Mark, I don't mean to put you on the spot here, but I'm going to. Curve token is up, well over 50 or 60% the last few months, yeah. And Bancor can't seem to get a green candle. So what's going on here for the Bancor community? But so I guess that's not even the question. It doesn't price is irrelevant, but I guess the question is more so on developing tokenomics that create value. I understand the deflationary kind of aspects, but let's kind of delve into that. I think Nate might have to go, but if you can stay on for a few minutes, Nate, if you have a quick thing as well on just kind of overall DEX tokenomics, would love to hear that before you go, and then we can keep going with Mark.
I do have to jump, guys, and I'm excited to hear the remainder of this podcast, because it's a conversation that we've definitely been having as a community. I will leave you with this, that the yields on Bancor tend to be so high that people kind of discount that. Like, if you look at the gains that you would have gotten over the past year from both the yields of staking BNT and holding it, you should consider that as well as the token price. But there's no question that Curve has a little narrative going for it right now, and the week before it was DeFi 2.0, and it was Ohm, and we'll always have these sort of DeFi flavors of the week. And I think it's our job as builders in the space to sort of understand from the noise what is real and what will deliver over long term the most value to the protocol and the owners of it. So I know that's quite vague, and I have to jump, but I know I'm leaving it in good hands with Mark, and I'm excited to hear the remainder of this. But thanks, guys. I'll talk to you soon.
Yeah, thanks for coming on, Nate.
Okay.
You're the man.
Bye.
Cheers, Nate.
Yeah.
So, Mark, what the hell's going on?
With the price. Yeah, I did. It's a fair question. It's something that we talk about.
And real quick, Mark, you can speak broadly too about because like Sushi and Uni are seeing the same thing. It's not like it's just Bancor. Trader Joe can't seem to get back up after its initial all these DEX high emission tokens. Just what's the tokenomics that are going to fix that are going to bring them back to life almost.
Yeah, absolutely. So yeah, a couple of things. So yeah, you mentioned, and I've got the. I'm just looking at the curve chart now, actually, and you're right. Like since the crash back in May, curve has done extremely well, and I think that it is. It's definitely fair to attribute it to sort of the success of its tokenomics model. But part of me always wants to remind everyone that it's still kicking the can down the road. Because 4 years from now, they're going to be unlocking a stupid amount of curve tokens, and that's going to probably have an effect. So in a way, it's probably saving up for this like mega dump, in 4 years' time or something. But that's just me speculating. Anyone listening to this, don't listen. I'm from a rival project. I can say whatever I want about another token's price. It doesn't mean anything. But but personally, this is something that I am worried about in the space. I do pay attention to lockups because I don't think they're healthy. I think that a lockup with a slow release schedule is okay. You do want to have a functional market, and giving people the ability to dump whenever they want is probably not good. But having sudden unlocks is not good either. Although it is good for the price in the short term. But even then, considering all of these things, I'm looking at at Curve's bottom this cycle was 30 cents. And it's up like $5 right now. So let's be generous and call that a 20x. Bancor over the same time, like during the same cycle, started at 11 cents. So it's already done 100x and then capitulated back down to 30x. So I'm not really worried too much. I think in the grand scheme of things across DeFi, the trends on all of these things look pretty much the same. You can have a look at like the Link chart, for example, which I'd say the Link token and the Link project are among sort of like the most fundamentally valuable in cryptocurrency, and I don't think that's controversial. But they've also been struggling with their token price and stuff. And so I think that
price. It doesn't always represent what's actually happening. Like Nate kind of hit on, right now it's the convex curve narrative for Curve. And we're going to see the same thing with the token, and just as more and more projects pull these kind of locked models out. Now, unless you have something pressing, I'd love to kind of hear more about the idea of locked and linear release liquidity mining. So there's a really big project on Twitter, again, kind of the narrative now, right? Like I've been in it for months. I got lucky with it, but this DeFi Kingdoms project with the Jewel token, they've been doing yield farming at insanely high rates. Like when I first got in, it was 4,000%, and it stayed like that because it was unknown for like 2-3 months. Now most of the pairs are down to about 400%, which is still absurd. But here's the kicker. Starting July 15th, 2022, 80% of your rewards are released linearly for a year. So up until July, you're getting 20% immediately. So still 20% of 400% is what, 80% of 4,000%, 800%. So it's still really damn good yield in the near term. But we got to see what's going to happen to the token come middle of this upcoming year, right? So I'm curious what your thoughts are on kind of like this split lock liquidity mining, if this is something that could be used, if there's a way to do liquidity mining with more splits, lockups, and governance, or if it's all just kind of like the same iterations of just kind of creating value through new token missions. Yeah,
absolutely. I think that so I'm familiar with the dual LM schedule. It's something I had to look at recently. I'm actually pretty impressed with it. I think that it is likely to help keep the market functional for longer periods of time. One of the things that that kind of shakes the people from traditional finance pull their eyeballs out when they have a look at the type of volatility that we're experiencing in crypto on a daily basis. And a lot of that volatility over the last year, I think, has actually been sustained by things like liquidity mining schedules across the space, because there's so much new value being injected, and that value gets split through inflation of all of these projects, different tokens and whatnot. And I think partly this is why saying lockups are a good thing, right? Because you do want to be able to sort of give the market time to react, right? No one likes to be surprised when someone suddenly decides to dump 25% of the token supply. And so that's bad, right? It's really bad. You do want to protect against that kind of thing. But then, once you start that lockup, right? Like, let's say the DAO decides, okay, no one gets the liquidity mining for a year, right? And then all of a sudden, the lockup period is coming to an expiry. You might not blame the DAO for thinking, you know what, can we put it off for one more year? I really don't want to see all of these tokens suddenly end up on the secondary market. And then, eventually you kind of end up in this spiral. And so I think then that this is where the linear release is actually a really good answer to that, where you say, okay, we're going to deal with this once and for all. We are going to do this inflationary schedule, and that's that. And we are going to lock up your tokens. You're not going to be able to sell them all the time, which is great, because the mercenary DeFi users, the ones that don't really care about the projects that they're liquidity mining on and are just there for sort of the fast turnaround, they're generally the customers that you don't want, and they're going to be probably put off by some of these lockups and linear vesting schedules. So it's a good idea. I do think it's a good idea. It's a way that we can kind of tame the beast, where people still feel like they're getting those amazing rewards.
Yields.
The
yeah,
yield,
it's like, holy hell, 4,000%. But then I'm like, oh wait,
oh my god,
I can't touch these.
It's like, they get to keep looking at you cutting up that pizza into smaller and smaller pieces. And so they still get to be, excited about how many pieces of pizza there are now. But the trick is that, unlike the pizza analogy, when you're doing these kinds of splits, each piece can actually grow in value as well. Just because there are more tokens doesn't necessarily mean that the price has to go down. Which means that these kinds of linear vestings could be an important component of that. One of the things that I like, when I'm saying that I'm critical of the lockup, it's because often you haven't yet paid the price for those emissions. So when people see the token price, you're kind of fooling yourself, right? Like, it's like one of these, my favorite analogy for this is I'm going to create, Andy coin, right? And we're going to print 1 trillion of them, right? So the contract's going to have 1 trillion supply. And then I want you to buy 1 Andy coin from me for $1, right? We'll just OTC deal $1 of Andy coin. And then what is our market capitalization now $1 trillion? Because there's 1 trillion coins, and the last sale for 1 coin was $1. It's like, well, maybe that market capitalization isn't real, right? We need to find out how much people are actually willing to pay for Andy coin. And that's what lockup doesn't give you.
Yeah, and we're seeing that with Jewel, because the FDV on it is like 10 billion.
Yeah.
The current market cap is 1 billion. But the thing is, as you're saying, as long as the linear vesting, kind of works in terms of people don't dump immediately and the token price continues to go up. It's surely an experiment, and I'm obviously invested in it. It seems as if you are as well. I'm sure a lot of people who have seen it on Twitter have probably got in some,
I'm invested in the idea. I don't own any.
Not necessarily the project. I got you. Yeah. We'll see, because if it kind of works, then we could probably see a lot of these GameFi projects do a similar kind of schedule.
In a way, every generation needs to relearn the same lessons. It's unfortunate, but it's true. It's why we've got idioms like history always repeats itself. What we're now starting to do with these vesting schedules and liquidity mining, but you can unlock some now and you're going to get some later, that kind of thing. This kind of stuff has existed in the centralized markets since forever, right? This is a big part of financial regulation, right? So it's interesting to see that left to our own devices, crypto's kind of learning to self-regulate. Like we've done the stupid thing, right? Where it's like, whatever, the token supply can be whatever we want. We're going to pay our users and our VCs and ourselves thousands and thousands and thousands of new tokens. Like, there's no consequences. And then it's like, shit, fuck, okay, there are consequences. We need to do something about this, right? The thing is that in centralized finance, it was governments that were stepping in and saying, I'm going to show you what works and what doesn't work. Or it's like, you idiots, of course you can't just make free money. You need to find the market. You need to give the markets time to adjust, right? You need to have some sort of bona fide price discovery process. And in crypto, it's like, yeah, we did the experiment. We now agree, but we don't need a regulator to tell us what to do anymore. The community is kind of learning to do it itself, and I think that that's extremely helpful. And this is why I'm paying attention to things like Jewel, is that they are representing.
That's huge, man.
It's huge. This first epoch of self-regulation behavior. It's good. Yeah. And I think that this is what I hope people say about Bancor one day. And when we're talking about self-regulatory behavior, we're not just talking about emissions and inflation versus deflation and currency valuation and all of that kind of thing, but also more broadly, can we actually sustain a decentralized financial system? Like, what protections do you need to give people? Because the banks in the traditional world, they still have to offer insurance. They still need to be insurance policyholders in case something bad happens and they can't afford to to refund all of the bank accounts that they're responsible for. They need to do that, and that's part of that's if you consider things like DEXs to be sort of quasi-online high-interest savings accounts, which I do. I think that is the closest analogy that we have. It's like, yeah, shit, maybe we should figure out how to insure it. And I don't necessarily mean against smart contract risk, which is like what Nexus is already annexing, what Bridge Mutual and others have already figured out how to do. But how do you insure against financial risk? Not anyone necessarily exploiting the contracts, nothing getting hacked, but users still losing money because they made a bad financial decision and we didn't educate them correctly about how to hedge against it. So that's what Bancor is doing, right? The Jewel thing is a very specific case. How do we self-regulate inflation? Bancor is much, much more general, much, much more, I dare I say, difficult. How do we self-regulate as an actual, financial industry? And so, yeah,
there's a whole article to be written about this, the self-regulation of new projects, new Ponzi's, self-regulation of inflation, the self-regulation of, as you're saying, like the emission schedule of the inflation, of creating new tokens, and of debt. And I think DeFi has done a pretty good job so far of not unleashing too many under-collateralized debt protocols.
Yeah,
and stuff
exactly.
Like that.
Yeah, it's also done a pretty bad job. Yeah, we're getting there. Exactly.
I hear you.
It's like it's all over
Mark,
the place. Yeah, go ahead.
Yeah, it is. Any closing thoughts, man? We're kind of gonna wrap it up here. If Rob has anything else as well, we got a 2-minute window here. And yeah, it's been a pleasure to talk about everything DeFi.
Yeah, I mean, I'm so excited to talk to you guys. Honestly, if you ever want to chat again, you know how to reach me. Maybe after our version 3 is out, we'll have a lot more to discuss. But yeah, I just in closing, I think that of at least this last part of the conversation, with regards to protocol and liquidity, emission schedules, liquidity mining, the ridiculous yields in DeFi. I just think it's 2022 is probably going to be a really good year for the DeFi community to sort of sober up a little bit and work out whether or not we're in this for a good time, or are we in it for a long time, or can we have a bit of both? And I think that that's what Bancor version 3 is a testament to, right? It's not just about milking a token for everything that it's got. But it's also not sort of, a boomer protocol either. It's somewhere in the middle. And we're trying to find that balance between giving users what they want, right? Which is fairly high returns on their money, and I think that they are owed that. But also, how do you do that forever? And you can't do it with inflation, so there needs to be another answer. And I think that if I had any closing thoughts, it would be to remind people of that we can't keep relying on these inflationary mechanisms forever. There needs to be something underpinning it if we want the industry to be taken seriously. And that's where I want us to be.
Yeah. Thanks, Mark. We hardly touched on V3, and that's probably a conversation for another time. But I think we went really deep on V2 and almost a recap of what worked, what didn't, and now this is kind of really setting up a solid introduction into V3 and the different narratives that are kind of swirling around. That was quite a conversation on the curve wars, which I'm still kind of getting my head
I don't want anyone to get I don't want anyone to get the wrong idea. By the way, I'm a huge fan of Curve. Like I said, I've their white paper, the original like stable swap invariant introduction, is one of my favorite white papers in the industry. I'm a huge fan of that project. I'm just a little bit concerned with the way that their governance thing is going, but I have absolute faith that they're going to self-correct, just as Joule is doing, just as Bancor is doing. But yeah, it's
don't worry. I think the Curve community is doing all right. Maybe you should focus on the BNT community while you're at it. I think the Curve community is doing all right. I don't think they're too worried right now. No, I'm messing around. But yeah, good stuff. Agreed. It's going to be interesting to see how these unlocks happen. They should implement a linear schedule ASAP. But we'll continue this conversation. Mark, thank you so much for coming on.